A little while back, I sent $74,000 to buy a stranger's mortgage. A person I've never met, in a house I'll probably never visit. And on the 1st of that next month, their payment showed up in my account. Exactly like it was supposed to be. No tenants, no repairs, no phone calls, just a payment. I want to walk you through that one deal, start to finish. Because it's the clearest way I know to show you what becoming the bank actually looks like. When it stops being a slogan and becomes a number. If we haven't met, I'm Mario. I run Ritsel Notes with my wife Lorinda, and I've been in real estate since 2006. I started in single family homes, the normal landlord path, and I came into it with a finance background. So I'm always scared about the money mechanics under the property, not just the property itself. So over the last 5 years, I've shifted more and more to the loan side, buying and holding notes, because honestly, after years of owning buildings and managing all of the headaches that comes with them, owning the payment instead of the property just made more sense to me. So this $74,000 is a deal that isn't theory. For us, it's a Tuesday. So here's the setup. There's a homeowner. I'll keep him anonymous, but picture a normal family living in Ohio. They took out a mortgage years ago and they've been paying it on time, month after month. The remaining balance on the loan, the unpaid principal balance, is $80,000. Nothing dramatic. A steady performing loan. In this world, boring is exactly what you want. Now the bank that holds that loan doesn't necessarily want to wait the next 20 years to collect on it. Maybe they want the cash now. Maybe they're cleaning up their books. Whatever the reason, banks and lenders sell these loans constantly. It is normal. Everyday part of the mortgage market that most people never see. So the note comes up for sale, and instead of the bank buying it, I do. I pay $74,000 for an $80,000 balance. That's about a 7.5% discount. And I want you to notice how modest that is. Performing note like this trade in a tight band, usually around 5 to 9% of the balance. Anyone promising you a massive discount on a loan that's being paid on time is selling you a story, not a note. Before money changes hands, there's homework. The part that actually protects you. You look at the payment history. Are they really paying on time? You confirm the first-lien position, which means this loan sits first against the property, first in line, ahead of anything else. You check that the property is actually worth more than the loan, so there's real estate standing behind the paper. That's the work. It's not flashy, but that's where the safety actually lives. Then the sale closes. And here's the quiet moment that still gets me. Nothing about the house changes. The family keeps living there. They keep making the same payment they've always made. The only thing that have changed is the address that payment goes to. It used to go to the bank, now it comes to me. I become the bank on that loan. So let's talk about that $74,000 and what it does. Taking the discount and the monthly payments together, a performing note like this tends to land somewhere around 8% a year, if I let a professional servicer handle the collecting and the paperwork. And I have to say it plainly, that's an example, not a promise. Every note is different, and you should always run your own numbers with your own advisor. Now that 8% assumes I'm hands off. If I self-manage the note myself, handle the servicing relationship, stay close to it, maybe negotiate a little bit more upfront, I'm not paying someone else to do that, and that same kind of deal can move upwards to 10%. That's a trade. A little more involvement for a little more return. And that's actually the honest map of how anyone gets into this. There isn't just one way in. There are actually 3 ways. And they all line up with how much you want on your plate. If you're hearing all of this for the first time, the right step is to simply learn it. Understand the mechanics before you ever wire a single dollar. If you like it, but you're busy and you'd rather have someone else run it for you, you can invest alongside us, passively, and just hold the position backed by first-lien real estate. And if you want the full control, and that's shot at the higher end, you own the note yourself, and you might even self-manage it. Same deal, 3 different seats. Compare that to a rental I used to chase for some kind of money. The rental comes with a tenant, a furnace that dies in January, a vacancy that someone moves out, and my phone ringing on a Saturday. People call that passive income. It isn't. I've lived it. This note, the family handles the house. I handle nothing. I just watch the payment coming in every month. So here's your next step, plainly. Don't go and buy a note tomorrow. Learn how it works first, in plain English, so the whole thing stops feeling like a magic trick and starts feeling like what it is, a normal transaction that you were just never invited into. That's exactly what the free 5-day Become the Bank Challenge is built for. 5 days, 1 short lesson, and 1 small action each day. No obligation at the end of it, just understanding. The link is at the very top of the description. Start there, and the free doors are all open to you from that point. And I mean it on the conversation. If you earn this note, would you take the hands-off 8% or self-manage and deal with it yourself for a shot at 10? Tell me in the comments. I read them and I answer.